Good afternoon, everyone, and thank you for taking the time to join us today for Ironwood's Quarterly Market Insights webinar. My name is Preston Morris, and I'm the Portfolio Manager here at Ironwood. Our speakers this afternoon will be Alex Merrick and Mario Nardone. We have a lot to cover today, so if you have any questions, please submit them to the GoToMeeting box, and we will field them at the end. Alex, the floor is yours.
Great, thanks, Preston. Good afternoon, I suppose good evening for some of our attendees, depending upon where you are joining us from in the country. Happy to be speaking with you tonight. You know, as some of you may already be aware, this year marks Ironwood's 20th anniversary, which is really a milestone that we see as a testament to the trust that you've all placed in us. To be honest, it's hard to believe it's been 20 years, although my children on my recent birthday had no problem reminding me of my age. In fact, they said, they mentioned I was born in the 1900s, so I don't think they got that right. But at any rate, on behalf of everybody at Ironwood, I would like to say a sincere thank you for the opportunity to grow alongside you and your families, and for the loyalty that you placed in us over the past 2 decades. You know, one of Ironwood's core guiding principles has always been to never stop improving. We aren't interested in resting on our laurels. We're here to build the infrastructure for the next 20 years. And, you know, part of that evolution will include things like upgrading our tech stack and our offerings. In fact, in the next month, we'll be making the transition to an upgraded client portal and performance reporting software offered by a company named Black Diamond. So stay tuned for more details on this launch. You'll be getting correspondence from our office in regards to this. But tonight I want to focus on a big step that we've taken in terms of upgrading our investment research. And I'm really excited to introduce our new partnership with East Bay Investment Solutions. Our relationship with East Bay adds a whole new level of institutional depth to our internal investment committee. I'll be talking more about East Bay in a moment and introducing our main presenter tonight, Mario Nardone. By the way, Mario wanted me to mention not to be fooled by his picture. He did not just graduate high school. In fact, I know he's been in the investment management industry for over 25 years. So anyway, before we dive further into the East Bay partnership, I just want to take a moment to mention some adjustments we'll be making to the timing of future quarterly market webinars. Okay, next slide. Great. So based on feedback from clients, we decided to adjust the timing of the presentations, and that'll start in the beginning of the 3rd quarter with August's presentation. Our goal here in making these adjustments is twofold. Number one, we want to make the live presentation accessible to more clients. And secondly, we'd like to try to provide the information in a bit of a more timely manner. So with that in mind, we'll be hosting the live webinar earlier in the day. The hope with this change is that it'll allow a greater number of people to participate. Pardon me. It might also help those of you joining us from the Eastern time zone. So I looked, shout out to people joining us tonight. We've got Connecticut, Florida, South Carolina, including Mario from South Carolina, who are joining us where it is after 7 p.m. as opposed to where it's 4 o'clock here in Arizona or on the West Coast. So in shifting to earlier in the day, we're hopeful that allows, well, we'll allow you to enjoy an evening free of economic data if you're living back east. And for all of us to have a bit more energy to focus on the material because we understand it can be heavy. Keep in mind, right, we will continue to record the presentations and they'll be available for replay on our website. This has been a pretty popular option. A lot of people just aren't able to make the time. So we've had a lot of folks watch the replay. So keep that in mind that it is available if you'd like to rewatch or if you need to sign off early. It'll be there within a couple of days. Okay. So that's the first change. We'll move to a bit earlier in the day. The second thing that we're going to do is we're going to shift the date up by a few weeks. So we expect to host future webinars in the month directly following the end of each calendar quarter. So the hope here is that closing the gap and making the presentation closer to the end of the quarter will provide everybody with data that's just maybe a little bit fresher. These changes were prompted by suggestions from clients, also from Ironwood staff, and we really continue to welcome any feedback that you may want to provide in the future about these presentations or any of the other events that we host. All right, with that bit of housekeeping out of the way, I'd like to dive into how and why we expanded our think tank through a strategic partnership with East Bay Investment Solutions. So you'll see some bullet points that you can read, but I'd like to give you a bit more background. This is a partnership that Ironwood has been evaluating for over 2 years. And earlier this year, we decided it was time to upgrade our brain trust, really, by formally engaging East Bay as an institutional research partner and portfolio strategist. It's been a priority of ours to broaden our internal capabilities. And I believe this relationship with East Bay does just that. These folks are a team of veteran CFA charter holders who are going to give Ironwood a deeper bench of institutional grade research and analytics. These folks have provided investment strategy to some of the largest global firms like Vanguard, Goldman Sachs. So naturally, we're pretty excited to bring that level of experience to Ironwood's portfolios as well. I feel like East Bay is such a natural fit due to their like-minded fiduciary approach that's so similar to Ironwood's. They're research-driven, they have no product affiliation, and no compensation conflicts. So Ironwood pays East Bay a flat fee, right? So we pay them for their insights. And we think that this structure will allow them to operate objectively and to focus solely on what they believe is best for our portfolio models. There's a point I really want to drive home is that East Bay's oversight is designed to support Ironwood's internal investment committee, right? Our committee approach to decision-making is not changing. We're simply getting additional input and research from the folks at East Bay. Our investment committee will hold monthly meetings with East Bay to understand their perspective on the market and the economy and to discuss any potential portfolio adjustments that they might suggest. And then every quarter, East Bay will conduct a formal review of the performance costs and allocations that we're using in our portfolios with the objective of making sure that our portfolios remain aligned with our investment philosophies. I also think East Bay will be a valuable resource in terms of handling the initial evaluation of inbound investment opportunities. As you might imagine, we are approached often with new funds to consider, and vetting those funds is a lot of work. And that's something that East Bay can help be supportive of for us as well, which is great. All right. I see probably the biggest draw, right, in this engagement with East Bay was because of our shared beliefs in terms of the investment management process. Both Ironwood and East Bay believe that model portfolios should be built based upon the principles of something called modern portfolio theory. And you see on the slide, right, this is a Nobel-winning framework that really is focused on diversification and asset allocation. But let me try to use some like plain English here. I look at modern portfolio theory as being grounded in the science, I suppose, of building portfolios that make sure to include some assets that zig when others are zagging, right? So everything is not moving in the same direction. So when we evaluate investments, the question isn't just, is this a good fund, right? We're also focused on, well, how does this fund interact with the other assets that are in the total portfolio, right? And this relationship, guys, is critical when it comes to being able to deliver reliable retirement income and having confidence that college funds are available like at the time when they're needed. The other thing I think philosophically that we are fully aligned on, East Bay and Ironwood, is that we agree that the most prudent approach to investment decisions is not based on emotion, right? It's based on evidence. I can tell you something. In my nearly 29 years in this field, something that's been proven time and time again is that success in investing isn't about ignoring your emotions, but it's about having a disciplined process in place, right? So you can not allow those emotions to dictate decision making that could maybe hurt your future, right? So that shared philosophy is really, really important to us, and we would not have been able to have a successful partnership if we didn't. If both parties weren't coming from that shared belief. So let me talk a bit about how the partnership works. I look at this really as a collective think tank, right, where a variety of different perspectives will be considered. A really big important goal on hiring East Bay was to reduce the risk of us making any biased decisions when it came to investing. And I think we've all heard of like the echo chamber effect in the news, but it's a real risk in investing too. To solve for that, we brought in East Bay, right, to challenge our assumptions, to act as a barrier to any confirmation bias that could potentially affect strategy. The one question that I've heard a few times and my colleagues have also heard related to this partnership is, well, who's making the ultimate call, right? Like who's making the decisions? And I really want to be crystal clear about this. We believe that East Bay will bring a really great system of checks and balances and that they'll enhance our process. But Ironwood will always retain final decision-making authority, okay? All right, I've talked a lot about analytics and committees, but really, I guess the bottom line from my perspective is the reason we pursued this partnership is so our advisors can spend more time focused on you and your specific goals, right? And to have confidence that we have the portfolio, the portfolio construction is being as thoughtfully considered as possible to help support those goals. So I think that's a fairly good intro to East Bay and our partnership. So now I'd like to turn to introducing our main presenter, Mario Nardone. Over the past several months, I've gotten to know Mario fairly well, and I've really, really enjoyed the work that our investment committee and that I have been able to do with him. So Mario is a founding partner of East Bay Investment Solutions. He lives in Charleston, South Carolina, on the outskirts of Charleston, South Carolina. As I learned, without fiber optic internet yet, although it's coming soon, apparently, which is good. Mario began his investment career in 1999 with Vanguard in Valley Forge, Pennsylvania. In 2003, he earned the Chartered Financial Analyst designation, and he continues to mentor aspiring charter holders today, or charter candidates today. Mario is also the past president of the CFA Society of South Carolina and a former chairman of the College of Charleston's Finance Department Advisory Board. He's been featured in one of our leading trade publications, Investment News, and also heard on South Carolina Public Radio. I'll tell you a bit about the personal side. When he's not conducting investment research, Mario enjoys spending time at Charleston's beaches. I understand that he is a scuba diver, and taking advantage of the city's restaurant scene. He also spends a portion of the summer in coastal Maine, as do I. So Mario's more in coastal Maine. I just looked at a map of where he'll be, and it's further north. And for any of you who haven't been to Maine, my experience is the further north you go, the more beautiful it is. But at any rate, he will be in Maine for a portion of the summer with his wife Piper and their daughter Pepper, son Santino, and I'm not sure if Simba the cat takes the ride. Maybe Mario can let us know. I have to say, Mario, that I think that you and your wife have a total gift for picking names. I love those names. So anyway, folks, I've seen the research that Mario and his team have produced over the past few months, and it's really been invaluable to Ironwood. So with that, I'm excited to hear from Mario tonight. So why don't you take it away?
Hey, thanks, Alex. and I have the chat window open. If anybody needs to let me know anything, please feel free to send a message. Wow, that was such a great introduction. I think, I'm not sure which part was my favorite, but I really appreciate that. My favorite word on the slides was synergy. East Bay was designed to work with firms like yours and with the clients that are on the call today. We really appreciate the work that you do with and for them, and it's our honor and pleasure to work with all of you in that capacity. With that, as Alex said, there is a lot to cover, and we'll do the best we can to get you back to doing the things that you truly enjoy. And if there's any questions, I think Preston's going to handle those, and we'll be sure to answer those at the end. So again, I'll try to be thorough, but also succinct, and let you guys get on with your day. But if there's anything at all that we could do for you, please feel free to pass it along to your team at Ironwood. They'll pass it along to me, and we'll work together to make sure to get your questions answered. So with that, let's get into the presentation. This may be a little bit different than the format that you're used to. Hope you like it. If you don't, again, feedback is golden. So please feel free to let us know what you prefer to see more of and what you prefer to see less of. The way that we start all of these presentations is to take a balanced approach to the economy, to the markets. And again, I'll kind of refrain what Alex just said about moving this conversation earlier in the new quarter, because this is going to be based on March 31st data. We're more than happy to answer questions of what's transpired since then. We'll do the best we can in future conversations to make sure we do this with fresher data. But nonetheless, the real point of this is to make sure that you understand how we're viewing the economy, how we're viewing the markets. Sometimes material and data comes a little bit later, like economic data, inflation data, that sort of thing. So it takes a little bit to digest, but the whole point isn't to try to figure out where we're going. Our investment strategy is not based on prognostication, but it is based on years and years of evidence and experience. And the most important part is understanding how that we are positioned to weather the storm, whatever that storm may look like. So let me just kick off. And again, without trying to take too much time on ancillary comments, we always try to approach these conversations in a way that is balanced, because we know that some people approach things with an optimistic view and some people approach it with a pessimistic view. And there's some elements of truth in both of those. And some of these slides are going to be very text heavy or data heavy, and I'm not going to read every bullet point. But on the left side of your screen are some of those bullet points, or some of those ideas that might be more akin to the glass half full story. And on the right side is the glass half empty story, and all of it is true. But on the glass half full side, I'll call your attention to the second and third bullet point, and that is that our economy has remained resilient and continues to grow. As of the publication of this presentation, inflation and unemployment have remained stable. We got a little bit of an inflation surprise more recently, but still probably not that surprising given the state of the world, and especially the topic on a lot of consumers' minds being the cost of oil and gas, which is a huge input, not just on our own everyday lives filling up our tank, but transportation costs that go into the prices of goods and services that we consume on a daily basis. On the glass half empty side, the top bullet point is certainly the first and foremost on everybody's mind, and that is the war in Iran. The word uncertainty is probably the most important thing from an investment standpoint. There's always chaos somewhere, but when it's, when there's something like geopolitical unrest, uncertainty really does weigh on the minds of investors and consumers. And that is clearly the most important factor right now. Next slide, please. Again, data heavy slide, very busy. So don't try to read it right now, but if you're on the recording, you can always pause it and read it if you like this kind of thing. But essentially what this slide does is call attention to a few of the most important or surprising facts and figures from the period in question. The two of them that I think are the most relevant or interesting are the first and fourth. The first one is a bit of a spoiler for a slide that we'll discuss later on. It does pertain to the war in Iran, because when that started, a lot of investors wondered how that might impact the stock market. You might be one of those folks who wondered how that would impact your investments. But what's surprising to most people is that in the history of geopolitical events, the stock market measured by the S&P 500 has actually averaged about 8% over the 12 months following the massive geopolitical events of the last few decades. And again, we'll get into that in a moment. The fourth bullet point is probably something closer to home for you, and actually a little bit of evidence of this kind of thing. And that is that the average year-to-date return, again, through March 31st, is probably a little better than that by now. But the average return of a balanced portfolio of 60% stocks and 40% bonds was only down close to 2%, despite the onset of the war in Iran. So it really goes to show you something that Alex touched on earlier about building portfolios that are resilient, and the fact that sometimes investments surprise you, and the things that you think are going to really have a massive impact are really just a component of the factors that go into what determines investment returns. Next slide. So we're going to start by thinking about the economy for a second. And when we do that, there's obviously a lot of factors, but the three things that generally come to mind about the economy, and this is what the Fed really looks at too, is inflation, economic growth, and employment. And that's the way that this slide is organized. So if you look at the left side, you see measures of inflation from a year ago, 3 months ago, and the most recent quarter end. So I won't focus on the left or the right side, because we see there that inflation and the unemployment rate were relatively stable, again, until that most recent reading where inflation seems to have picked up a little bit, not surprising given all the conversation around energy. But the middle part shows you that versus last year, versus 3 months ago, GDP, and also I must point out that in economic growth measured by gross domestic product always is reported on a lag. So the most recent reading was 0.5% growth, much lower than what we saw 3 months before that, and lower than we saw a year ago. Most of that has to do with the government shutdown, not necessarily the war in Iran. And when you consider the fact that the Fed's job is to balance all three of these, you can really see their challenge. Controlling interest rates, lowering it when it's time to increase economic output, raising it when the economy grows too fast. It's kind of a tough job, but they do their best to manage that. And again, when information comes in at a lag, it makes that job a lot harder. Stay with this slide for a second. So the three bars that you see at the left side of the page are the same factors that we just talked about: economic growth, unemployment, and inflation. And then the right side looks at three different metrics around energy costs. What the whole point of this slide is to show you that despite the headlines, and we all know that the media is compensated from generating, I don't even want to say subscriptions anymore, but eyeballs on their screen, they are going to create headlines out of things that may be headlines. Maybe they're not as exciting or dramatic as they should be. And this slide puts that in perspective. The gold spot on each of these bars represent the latest reading for each of these metrics. The blue line represents the range of these metrics readings over the last 6 years. And that's relevant because that's basically, it includes the COVID era and that sort of thing. So I'm not going to spend a lot of time on this slide, but I do want to point out that even within the last 6 years, we're not even at the extremes that we've seen. And yet we know that, the personal toll that COVID took on all of us notwithstanding, we got through it, right? Uh-oh. Can you still hear me?
I hear you, Mario. Yeah.
Okay. Something just switched.
Yeah.
So as long as you hear me, that's okay. But the point is that sometimes things that feel like extremes are not really that extreme, and we will get through it. And again, this is only the last 6 years. So if we expand that to this history of what we've been through and gotten through, this slide just puts that into perspective. All right, next slide. So we're going to go into what we, in the industry, our jargon is fixed income, but most people know that as the bond market. Each side of this page, go to the next slide, please. Each side of this page, and you will get used to this, this is just a new format, but each side of this page is arranged from top to bottom with the best performers of some important categories of bonds as far as what we keep a close eye on in terms of their performance for the most recent quarter. So for instance, on the left side, you have different components of the US Treasury market. It's arranged from top to bottom by best performing segment to worst, but we also show the 1-year performance of each of those. The main takeaway on the left side of the page is that short-term bonds outperform long-term bonds, and that's mainly because inflation concerns erode the present value of future bond interest payments. And the reason for that is that the longer these payments are extended into the future, the more that value is eroded because those interest payments are worth less if you think that inflation is going to increase the cost of things you want to buy with those interest payments. East Bay and Ironwood generally prefer the risk-return dynamics of short and intermediate term bonds in order to mitigate this exposure. On the right side of the page, if you look at the light blue lines, which represent the last 12 months, and importantly, this represents basically other parts of the bond market besides US Treasury. So we have bonds issued by US corporations, those issued by entities outside the US. You can see that diversifying your bond portfolio into these categories really would have been and was a boost to your total return. I'm actually going to skip the next slide in the interest of time. So if you might want to, yep. So this is really sort of an educational opportunity because what we saw in March, which is not that dissimilar to what we saw in 2022, when stocks and bonds both decreased in value, we, and I'm sure your friends at Ironwood got a lot of questions about, well, I thought that when stocks went down, bonds were supposed to go up. And that doesn't necessarily always happen. It's definitely an easy narrative. We certainly believe that bonds will smooth out the ride of an investment portfolio, but it's important to understand how bonds work. And the way that they work is that, similar to what I just said, if you have a bond that is yielding, say, 5%, but all of a sudden inflation picks up and that means investors expect more return from their bonds to outpace inflation, they're going to demand more yield from those bonds in order to outpace inflation and grow their wealth. So the bonds that exist in people's portfolios that pay those old lower yields are going to be worth less. And that's what we saw in that period. And that's something that we'll see from time to time. And we just really need to understand that sometimes bonds don't go up when stocks go down. A lot of times that's the case. But the most important thing is that bonds are there to mitigate that volatility or changing in price of the overall portfolio. But over the long run, we recognize and accept this relationship and still believe that a combination of stocks and bonds according to an investor's risk tolerance, goals and objectives, time horizon, and all of that is still the best way to build a core portfolio. Next slide. I think this slide is really helpful for understanding the relationship between inflation and bonds. I already alluded to this a little bit, but let's start with the dark blue line. That shows the yield on 10-year Treasury bonds going back about 70 years. And it's great that we have that much data because it really helps us understand these relationships. So again, but a similar concept to what we've discussed. An investor in Treasury bonds really expects to be compensated for two things. The first one is tying up their money for a period of time by loaning it to the government. That's what you're doing when you buy a bond. But the other part of their required compensation is the uncertainty of inflation. So at the far right, we can see that investors required 4.3% annualized return for the combination of those two components of risk over the horizon of a 10-year Treasury. So somebody who bought a Treasury bond on March 31st was demanding 4.3% for those two risks. The gray line represents the yield on inflation-protected bonds, which eliminates that inflation risk. The value of those bonds are going to adjust based on inflation, so those bondholders don't need to worry about that uncertainty. We call this the real yield. So you see that label there, the real 10-year US Treasury yield. The difference between the two, therefore, represents the portion of Treasury bond yields that are due to the uncertainty of inflation expectations. And we believe that collectively the market prices this in very effectively, almost on an up-to-the-minute basis. So if you take the difference between these two lines, again, at the far right, we can do the subtraction and figure out what we think, or what the bond market thinks inflation is going to be over the next 10 years. And if you look at the inset, you see that light blue 2.47, that's the implied inflation rate that the bond market foresees over the next 10 years. I know the headlines are telling us otherwise, but the market processes a lot of information, a lot of factors that go into whether or not that's going to persist, whether or not the Fed is going to step in and take control, whether or not the war in Iran will subside or go away, and energy prices might not have that much influence over the long term. And we really do trust the markets. If anybody believes that the market is not correct, we can talk about that. And please feel free to email or call your advisor, and we could talk about what actions you might take to account for that. But we really don't participate in the prognostication game. We're just here to understand what the market's seeing, how to build, once again, and forgive the repetition, resilient portfolios. So next, we're going to transition to talking about stock markets. I know a lot of people like to talk about stocks. It's always the higher headline. Personally, I enjoy bonds. Anybody who likes to talk about bonds can certainly set aside some time, and I'd be happy to chew the fat on that with you. But this is really the star of the show in most people's minds when they think about investments. So let's go to the next slide and see, in similar format, what were the returns of various components of the stock market over the last quarter? Once again, arranged from best performer at the top to poorest at the bottom. At the top, on the left side, you see US small value stocks. These are smaller companies that started the period trading at a discount. At the bottom, you see large cap growth. These are the largest companies that aren't necessarily trading at a discount. Growth stocks are those that virtually at any stock price, investors expect them to essentially grow into their price by increasing earnings, increasing profitability, and that is what we call a style of investing. And we'll talk in detail about some of the factors that went into this, but we did see large cap growth stocks pull back quite substantially over the first quarter. On the right side of the page, it's the same type of story, but we're looking at returns from non-US based companies, where at the top you see value, the only positive part of that market for the quarter. And at the bottom, we see large growth, again, exhibiting a little bit of a pullback. Now, the next slide actually has some pretty dramatic bars associated with it. This is the 1-year return of those same investment components. On the left, you see that US small value stocks were up 28%. At the bottom, you see that large value was still up very positively at about 16%. Very strong. The whole point of this slide is to show that we've had very strong returns across the board over the last 1 year, despite the last quarter's difficulties in terms of geopolitics. The right side of the page, you see extremely strong returns from investments in stock markets around the world. This is really the case for diversification, right? If we weren't participating in these international investments, we might not have experienced these extremely strong returns. And we'll talk a little bit more about that a little bit later. So with that, I already mentioned the war in Iran at least twice. Let's talk about a couple of slides that really drive some important points home. The next slide talks about, or really dives into that 8% number that I used on the year in numbers slide. So what you see here, again, a busy slide, but if you focus on the right side, these are 8 of the biggest geopolitical crises over the last few decades. And we're not going to go into each one in detail, but the way to read the slide is that the gold bar represents the initial decline in the S&P 500 as soon as these events happen. So you see the Cuban Missile Crisis, you see the Soviet invasion of Afghanistan back in the 70s, the Iraq War, Russian invasion of Ukraine. It is very clear that in every one of these geopolitical events, the market pulls back because they don't like uncertainty. But this really drives the point home, because a lot of people might think, well, what should I do? Does this bode poorly for the future of my stock market investments? And if you actually gave in to those human instincts of bailing out of your investment, you would have missed out on pretty decent returns over the next 6 and 12 months. And respectively, that is what the teal bar and that, I don't know, darker teal bar represent. 6 and 12-month returns subsequent to each of these geopolitical events. And if you look at the left side of the screen, you see that the average of all of these is that we've had a positive 5% in the 6 months after the event, and 8% positive return for the 12 months after that event. So if you bailed out, you would have missed out on those returns. And quite honestly, those are pretty much the average stock market return over any period of time. So despite what's happening in geopolitics, history tells us that there are so many more factors that go into stock market performance that we really shouldn't assume that one event is going to be that driving factor. Next slide, this slide really, I think, is very instructive when it comes to trying to understand that if-then statements really don't exist in investing. There are a few, but what this slide really shows us, and I have to describe it a little bit. On the x-axis, it shows you periods of time when the energy stock, or I'm sorry, oil price changed positive or negative. So you can see that 0%, that means oil prices are unchanged. To the right means oil prices were going up. To the left, they were going down. On the y-axis, that tells you the concurrent appreciation or depreciation of energy sector returns. So these are mostly dominated by your big oil companies. If there was a direct correlation between changes in oil stock or oil prices and changes in energy stock prices, This line would be a straight line from the bottom left to the top right. But the fact that these appropriately little blobs of oil, that's actually, I'm sure that's what you're seeing too, are all over the map. That tells you that there is not an if-then statement here. There is not a direct correlation between the price of a barrel of oil and the prospective returns of energy stocks. What's not on the page, but is easily inferred, is that if we can't predict the future of energy stocks by the change in the price of a barrel of oil, then what chance do we have predicting the overall stock market results by the change in energy stocks? For instance, what does the change in, if the price of oil doesn't have an impact on oil companies, then how can we predict how that's going to impact financial companies or those engaged in real estate or utility stocks? It's just not, there's no correlation there. And this is analogous to pretty much any attempt to make an if-then statement. And we just don't know. And of course, sometimes we do see times when oil prices are up and energy stock prices are up, but it's so unpredictable that we just choose to not play that game. I'm actually going to skip this slide as well. So one of the things, if you've paid any attention to the financial media, you might have heard the term Magnificent Seven. We've shortened it to the Mag 7. These are the large growth tech stocks or tech adjacent stocks that really have driven stock market returns here in the US for the better part of the last 4 or 5 years. The way to read this chart is that across the bottom, you see the year-to-date return. Every single dot on this page represents a stock in the S&P 500. The red dots represent what was called the Mag 7, and the media loves creating acronyms and names for things, again, because they like getting people's attention. They're now calling them the Hateful Eight. It's the Mag 7 plus Oracle. So those red dots representing those 8 companies are to the left of zero, meaning they've had a negative return. Again, year to date, this is through March 31st. But there are 2 important things here. The distance that they are below the y-axis tells you how influential each of these stocks were in the overall S&P 500 return. So they're to the left of zero means they're negative. Below the y-axis tells you how much they influence the S&P. And because these stocks are the biggest stocks or among the biggest stocks in the market, they have really been the driver of overall stock market returns to the positive for the previous 4 years or so. But so far this year, they've really been the laggards and the ones that have dragged down the S&P 500 from what it could have been or would have been if you look at the collective stock market. And all you need to observe to recognize that is all of those blue dots that are to the right of zero, including the ones all the way to the right, telling us that there are 3 stocks in the S&P 500 that have had returns 70% or more. So we really need to take some perspective out of this and remind ourselves that a handful of stocks could drive the market, but a diversified portfolio means that you are positioned to benefit when all the other types of investments are doing better and not being beholden to just those few dominant securities. This chart really does represent the dominance of these stocks, and I'm really just going to focus on the right side of the page for now. This chart shows you what percentage, and again, using the gray line, going back to 1996, this represents the share of the S&P 500 that is represented by the top 10 companies in the index. So at the left side of the right side of the page, pardon me for that, you see that the top 10 stocks in 1996 only represented 18% of the market. Follow that line to the right, and as of the end of the first quarter, you could see that the top 10 stocks represented close to 38% of the S&P 500. Now that, again, another way to show you how dominant these stocks are, but the importance of being diversified. Now, I'm a Vanguard guy. I have at least 5 John Bogle books, the founder of Vanguard, behind me, sitting on my desk. A couple of them are autographed. He's one of my heroes. He used to talk about all you need to own is the S&P 500 because these companies, you know, sell their wares to the rest of the world, and they're the biggest and best companies in the world. But, you know, rest in peace, Mr. Bogle. We do not want to be overly concentrated in the fortunes or the future of just a handful of companies that can be overly dominant if we really just own something like the S&P 500, or if we just owned a couple of these stocks individually. Now, there are probably a couple of you in the audience that were lucky enough to own a good position in some of these stocks, and that's great. And I would never, you know, sometimes I feel like I wish I was one of those lucky ones. But if I were, my first thing that I would do is try to diversify that exposure, because we have no idea what the future holds for those companies, and we just don't want to be overly exposed to that. I'm going to skip the next one as well. This slide is very instructive. It's very busy, and it's my favorite because I'm kind of an investment nerd. And if we need to go into it in detail, or if you don't understand it, we're happy to explain it later. But basically what this tells you is that one of the most important factors that determines future returns from stocks is not what's going on in the world. It's not what's going on in politics. It's not what's going on at the Fed. It's what are the prices that we're paying, or what is the price that we're paying for those stocks from this point forward. So what this tells you is at the bottom of each of these two graphs, it shows you the price to earnings multiple. Basically, how much do you have to pay for every dollar of earnings of a stock? In this case, it's the collective price of the S&P 500. So on the left side, you see that as you go from left to right, the higher price you pay, or the higher price to earnings multiple, the line tells you that you can expect a lower rate of return for the next 1 year. Now, these dots or diamonds are all over the page, right? So that tells you that it's kind of noisy. But the line, which is based on statistical regression, does tell you that the higher you pay, the less return you should expect over that next 1 year. The right side of the page tells you how important it is to pay a fair price for your stocks to determine your expected return over the next 5 years. This line and the diamonds as they're clustered around that line tell you that this is an extremely important data point. And it tells you that the starting price that you pay for stocks is a highly important determinant of your expected return. Now, I'm not here to be a doomsayer. I'm not the glass half empty guy that I talked about at the beginning, but it really does help us set expectations of what we should, sorry to be redundant, expect from S&P 500 returns over the next 5 years. As you can see, they're not all along the line, but that red dot tells us that we're towards the right of the line, which means that relative to average, because of the current price of the S&P 500, we should not expect average annual returns. Still positive, but not the average. So again, not trying to be a doomsayer, and also going back to the point where there's a lot of big companies that are dominating that data. We don't own just those companies. Yeah, stick with the bar chart, please. That's a good one. We don't just own those companies. We own all the companies in the index, all the companies outside the index, a lot of the companies outside the United States, So we're not necessarily just beholden to that somewhat sobering reality. This slide is really cool because you may have heard the term AI. I'm sure you have. You may have heard the term hyperscaler. A hyperscaler is basically some of the major companies that have made immense investments in AI and data. And what this chart shows you, based on that reddish orange bar, is that these handful of companies, in this case, it's only 5, Oracle, Microsoft, Meta, which is Facebook, Amazon, and Google, which is actually Alphabet, are expected to spend as much or more this year alone on the expected entire economic output of a handful of developed market economies or of global economies. That is an absolute immense amount of investment. And the collective wisdom tells us that we've seen this coming. The market knows that these companies are investing heavily in this area. But what happened in the first quarter is a little bit of skepticism that all of these investments are going to pay off. The valuation of these stocks combined with the amount of investment that they're putting into AI and other tech related operations may not result in the return on investment that many expected, or the optimistic view may not materialize. But again, this just goes to show you the scale that we're talking about, and partially why we're seeing some of the market gyrations that we've seen recently. The next slide tells us a little bit more about the benefit of investing outside the US, or maybe the I don't want to say the reasons against getting too excited about the US and pushing aside investments outside the rest of the world. This shows you, and focus on the top line, that grayish line. If you go back to 1987 on the left side of the page, that gray line represents the share of the global stock market that the US represented in 1987, around 30%. And you can see that line, zigzags a little bit, but ultimately the trend shows you that the US share of the global stock market has doubled to about 63%. And that has recently hovered between 60 and 68%. And this has, again, led a lot of people to say the US is the only game in town. Why do I need international? But we would use the blue line as the cautionary tale. And some of us are old enough to remember that Japan in the 80s was the industrial powerhouse, right? They were building the best cars, and I'm saying best in quotes because I'm sure there's a lot of opinions out there. But Japan was actually had the largest share of the global stock market at that time. So if you use the same logic that you use today about Japanese dominance in the 80s, similar to the US dominance today, you would not be a happy investor today. Because if you follow that blue line to the right, you see that Japan's stock market that started out as 40% of the global value of stocks is now 5%. And again, we're not trying to, we're not bemoaning the US. We do think we have a lot of things going for us in terms of capitalism and innovation and things like that, free flow of capital. The point is, we don't want to have a blind spot, and we don't want to get too complacent that all we need is US stocks because that's what's worked recently. One sort of wonky but very important fundamental factor that goes into the benefit of investing internationally is the value of the dollar. So let's focus on the top part of the page. If you look at the left side of the page, it goes back to 2002. This line represents the value of the dollar relative to a basket of non-US currencies. So you can see that from 2002, basically the end of the dot-com era through 2012, we saw the value of the dollar decline. That was concurrent with a 10-year decline in, or basically 0% return of the US stock market. International stocks did extremely well over that period. Since then, we've seen a significant increase upward and to the right in the value of the US dollar versus foreign currencies. This is important for a couple of reasons. One, we are mostly dollar-based consumers. So when the dollar appreciates, our dollar is stronger, meaning we can buy more goods and services that are produced outside, or that have components that are produced outside the US that are incorporated into domestically assembled products and that sort of thing. As an investor, stay there for a second, please, and I'll try to wrap up pretty quick. I might have to skip a couple slides, or I'll let you take over and decide whether to address the last few. When we're a US investor, a dollar-based investor in non-US stocks, an appreciating dollar is actually bad for us, right? Imagine, just hypothetically, if we were investing in a non-dollar investment, it means we have to give up our dollars to buy something that's denominated in a foreign currency. When we sell that non-dollar asset, we have to transfer those non-US currencies back into dollars. If they've appreciated over that period of time, we're able to buy fewer dollars back than we did when we initially made that investment. So investing outside the US is sort of a hedge against our non-dollar based consumption. So in the recent periods, again, going back to that theme of why should I invest outside the US? US stocks have been the dominant investment. Well, we don't know when the next dollar decline is going to be. And as a consumer, that's going to be bad for us. So why not hedge that a little bit and own non-dollar based investments, not only for diversification benefits, but again, to hedge against the consumption of non-dollar based goods that are essentially going to be increasing in price because our dollar is weakening. So with that, in the interest of time, I'm going to maybe see if Alex wants to continue. Like, there's a couple more slides, or do we want to move to Q&A?
I mean, if you think there's anything that you'd really like to hit on, it's being recorded, so folks can always catch the tail half of the recording if they have to jump. But kind of
okay,
yeah.
Okay, excellent. Well, then there's two more slides, and then I'll kick it back, I guess, to Preston. So the next slide, and you've probably seen this one before. I think this is absolutely when it comes to brass tacks as an investor, this is what it comes down to. So as you go from left to right, this slide shows the range of total return outcomes as you extend your holding period from 1 year to 5 years to 10 and to 20. So for example, we love to talk about the 60-40 portfolio, 60% stocks, 40% bonds, very a likely portfolio for probably many people on this call. So let's focus on that gray bar, and that represents the 60-40. So on the left, we can see that the best 1 year return of a 60-40 portfolio going back to 1950 was 34%. The worst 1 year return was negative 20%. The first thing to point out is that a negative 20% in a balanced portfolio should not be a surprise. This is something that we need to be comfortable with. It's part of the risk tolerance conversations that I'm sure you're having. It just should not come as a surprise. But as we move to the right, even just extending our holding period to 5 years, you can see that range of potential outcomes has significantly narrowed. And what this tells you is that since 1950, the worst 5 year return is still a positive 1%. Now, does that make you very happy? Probably not. But it does tell us that as long as we stay the course, we should expect our range of potential outcomes to narrow. And as we move further to the right, all the way to the 10 and 20-year period, which arguably is the investment horizon for most of us, whether we're new to the workforce and have maybe a 50-year horizon, or even if we're new retirees, we still have no idea what our life expectancy is. So longer time horizons are really what we should plan for and expect to the period we should hang in there for lack of a better word. So if you go all the way to the right, that 20-year rolling period, you see the best 20-year period for a 60-40 is 15%. The worst was 5%. And the further and further you go, you see that narrows closer and closer to the average, which you see in the inset of 9.4% average return over the last 50 years of a balanced portfolio of 60% stock and 40% bonds. And to really drive the point home, the last chart is pretty popular in our industry, goes by a lot of names. Some people call it the periodic table of investment returns. Some people call it the quilt chart for obvious reasons. What this shows you is different asset class returns by calendar year. Going back, the third bar from the left shows you the calendar year 2011, all the way to the right shows you 2025 and the year to date through the first quarter. You can see here, and I invite you to just focus on a particular color, and I think orange is probably the best one because it really stands out. That represents small cap stocks. All the other bars represent different parts of traditional portfolios. So you have cash, you have emerging market stocks, you have commodities, you have real estate. But if you focus on the orange, which is pretty similar story, no matter what color you're looking at, you can see that from one year to the next, the orange bars go from being the top performer to the bottom or towards the bottom and back and forth and back and forth. And it tells you that there's no way to predict which part of the market is going to outperform. Regardless of how many people in our industry try to do that, it's almost impossible. But the real standout and star performer, I think, is the white bar that's connected by the lines. And that represents a diversified portfolio of all these things, right? So if you have a diversified portfolio that consists of all these different components, you don't have to worry about which one is going to outperform or did outperform or underperform. You're going to, stay towards the middle. Now, you might have to give up being the best performer. You might not have a great story to tell at a cocktail party or whatever your social life takes you, but you can ride that out a lot more comfortably than if you tried to make these predictions, especially because of how difficult it is to be right and be right consistently in those predictions. So with that, I will turn it back over to Preston, and I'm still here for Q&A in case there are any.
Thank you, Mario. So as we just covered, the real through line across all of this is really pretty simple. Whether it's the situation in Iran or whether it's the Mag 7 underperforming, the data consistently shows us that investors who consistently stay diversified, they stay disciplined, and they don't let short-term headlines pull you off your long-term plan are the investors that tend to come out ahead. So that's really the big picture that we want to leave you with today. And we want to make sure that we also leave with a few minutes in case anyone has any questions. So please leave us a couple minutes and we'll give you guys a few minutes as well in case there's any lingering ones that we still need time to submit. All right, looks like there's no questions for today. So if anything comes up to mind after today, please don't hesitate to reach out to your advisor. And we hope everyone has a great rest of the Thursday and look forward to connecting with you guys again next quarter. Have a great day, guys.